Gentlemen, welcome back. I would now like to invite Professor Srinivas, Visiting Research Professor at the East Asian Institute, on stage. Prof Srinivas will chair and moderate our second session. Prof Srini, please.
Thank you, Yuan Sen. Good morning, ladies and gentlemen. It's a pleasure for me to be here and as a moderator of this session. A very warm welcome to all of you to the launch of this series of events focusing on China and India. We plan to have 2 such events every year, and each focusing on different aspects of the India-China relationship. For this session, the focus will be on economic issues. We'll keep you informed about our future events, and we hope and look forward to your participation in those events as well. Conversations like the one that we are having today are critical in the world that is facing multiple challenges, as has been mentioned by some of the earlier speakers. Trade tensions, conflict, climate change, just to name a few. How China and India deal with these global challenges, how they deal with their own domestic economic issues, how they deal with each other, and how they deal with the rest of the world, and vice versa, how the rest of the world deals with them, will have a big impact both domestically and globally. And for those of us who are interested in these 2 giant countries and their impact on the world, it is important to have these conversations where we can discuss, we can exchange views, and we can learn from each other. We are excited to be able to facilitate these conversations in Singapore, and as has been mentioned earlier, it is a natural base for these conversations. The timing of this event is particularly fortuitous. It comes after the elections in India in June, where Prime Minister Modi won his historic 3rd term. It comes after the 3rd plenum of the 20th Central Committee of the Communist Party of China in July, and the monetary and fiscal policy stimulus measures that have been announced since. It comes after the first meeting between Prime Minister Modi and President Xi in nearly 5 years in Kazan in Russia last month. And let's not forget, it comes a week after the US elections, which were held last week. So all of these have clearly implications for both of these countries, and I expect that many of these issues will come up during the conversation in the rest of this session. So we've focused on some of the more strategic issues facing the 2 countries in the last session. We will now move on and dig much deeper into each country's economy and discuss what their own economic plans are, how they may impact the world, and how global events and developments may in turn impact them. We have put together a fantastic set of 5 speakers to help us frame our discussions and share our ideas. Each of our speakers has a very long and distinguished bio. They are available in the material that you must have picked up at registration. They are also available on the event website. In the interest of time, I will introduce them only very briefly. I will introduce all of them together and then request them to come on stage one by one. Our first speaker is Professor Alfred Schipke. He is the director of the East Asian Institute and a professor of practice of international finance at the Lee Kuan Yew School of Public Policy at NUS. He has worked extensively on India and China prior to coming to EAI. He will provide us with an overview of the importance of China and India in the global economy. We'll then move to Dr. Stephen Barnett, who is the senior resident representative of the International Monetary Fund based in Beijing. He has lived in China since 2020 and is a China expert. He will share with us his views on China's economy. Dr. Ranil Salgado is based in New Delhi as a senior resident representative of the IMF there. He has worked in a variety of positions in the IMF for about 28 years and is now on his 3rd stint working on India. He will provide us with his expert views on India's economy. Following these 3 presentations, we will hear from Mr. Tae Kui Chin, Senior Vice President of GIC, and Dr. Taimur Baig, Chief Economist of DBS Bank. Both are based here in Singapore. Mr. Tae has been with GIC since 2006, and for the past 15 years has focused his work on Greater China and India. Dr. Baig heads Global Economics and Macro Strategy Research at DBS Bank and has previously worked at the Monetary Authority of Singapore, amongst his other positions. Both Mr. Tae and Dr. Baig will share with us their perspectives on India and China as market participants and as investors. The speakers will speak for about 10 to 15 minutes each. Once the presentations are done, I will invite all the speakers to be seated on the stage. We will then open up the floor to your questions and comments. The first speaker now, Alfred, over to you.
Good morning, everybody. 早上好. Real pleasure to be here at this critical juncture. What I thought I'll do is provide a little bit of a setting. Why do we really care about these two countries from a global perspective? And I'll start out by just repeating what has already been said a little bit. What is their global footprint? Then secondly, moving to that many of the global issues require both countries as partners at the table. I'll then focus a little bit on the bilateral relationship between the two countries. And we have heard that there are quite a number of differences between the two economies, but I'd like to focus on some of the similarities. And then last not least, that both countries actually have similar goals. So with that, I'm going to shock you a little bit because you've heard that China and India are the second and fifth largest economy. I'm going to just jump into this and say they're actually the first and third largest economy. This is how the IMF actually looks at the two countries. It has to do with how you measure the size of the economy and convert it into a currency, and we use PPP in order to do that. So by those measures, China is the largest economy, India is the third largest economy. But I think what you can see from these two figures here, how the world has changed from the early 1990s, where, of course, the US was the largest, but then you also had Japan and Germany. So what happens in these two countries ultimately has implications for the global economy and for all of us that have worked on those two countries. Whenever one of those countries changes its growth projections, we literally have to do the growth projection for the entire world again, so it's a lot of work. Here, I don't know whether you can see this, it's a little bit lower, but these are the projections of the IMF for global economic growth, and my colleagues will delve into those a little bit more carefully going forward. But just to highlight, global economic growth for 2024 is projected to be 3.2%. What I wanted to highlight is because of the growth projections for China and India, if you take those two countries together, 50% of global growth of the 3.2% are driven by these two countries. So it is not only that these countries are important, they literally are the key driver of global growth. And surprisingly, when international events talk about global growth, usually they start out with the advanced economies. But theoretically, they should start out with China and India because they are the ones that drive global growth. On the right-hand side, I was trying to show to you what happens if China's economy or India's economy does, for example, not as well as projected. So let's suppose you have a 1 percentage point less growth in China and India. And what you can see on the left-hand side, the two bars, is that 1% less growth in China has an adverse implication for the medium country in Asia and the Pacific. It means that they're growing 30% less than was predicted. The impact of China, India is still somewhat more limited, but as we were saying earlier, most likely that will increase over time. What are the linkages between these two countries, the global economy and especially Asia and Pacific? First, of course, trade. Secondly, supply chains. And in the case of China, it is also commodity prices that have a large implication. What is not so important at this juncture are financial sector linkages. The two countries do not really have large spillovers from their financial sectors. So the second part is that many of the global issues cannot be addressed without having China and India in the room and at the table. One of them, and especially now that COP29 is ongoing, is of course the issue of climate. Both countries are extremely vulnerable to climate change with humongous economic and social costs. Both countries are major contributor to carbon emission, but all countries have also committed to reducing carbon intensity and achieving carbon neutrality in the case of China by 2060, in the case of India by 27. Both of those have to be in the room, of course, together with the United States and Europe. And it turns out that both countries, and in particular their financial systems, are now starting to react to that. China now has the largest green bond market in the world, and maybe a little bit surprising to some of you is the fact that India now, from low levels, is catching up as well, especially in what we call the ESG markets, so basically the allocation through capital markets to sustainable industries, where we have seen a major surge over the last couple of years. And last year, the Indian government issued 2 green bonds, large green bonds that were extremely well received by financial markets. Maybe just a word about the bilateral economic relationships. Interestingly enough, the trade relationship remains very, very strong. It is true that China runs a bilateral trade surplus, or India has a deficit. But of course, what matters for economists are not the bilateral, but the global balances, and there India's trade and current account deficit is judged to be sustainable. The other part on the right-hand side is foreign direct investments. These are foreign direct investments of China into India by announcements. And what you can see, the red line is China, that there has been, not surprisingly, a significant slowdown that has been taken up by especially the United States and Japan. But if I were to be a predicting person, and I'm sure that we'll discuss that later on, including from our colleagues that are in the financial markets, I would predict that going forward we will see again a pickup of foreign direct investments into India by China. The third part is, of course, labor, where you have, in particular sectors, quite a number of Chinese workers in India as well. Now, China and India, as was indicated earlier, their economies are, of course, very different. First of all, in terms of development, India's economy is about, in terms of income per capita, 1/5 of that of China. It is, of course, also the structure of the economy, which is very different in India and in China, where in India, the agricultural sector, both in terms of value added, but also in terms of employment, plays a very, very large role. That is not true for China anymore, where it is manufacturing. But having said that, when you analyze the two countries, there are also a number of similarities. And one of them is the financial system. Both financial systems are bank-based, so they're driven by banks rather than capital markets. Not surprising, very standard at their level of economic development. The other part, though, is the role of state-owned banks or public banks. Now, I think most people know that China has large public banks or state-owned banks. As a matter of fact, they are the largest in the world. accounting to 45% of all bank assets. But what might not be so well known outside of South Asia is that India's financial system has state-owned banks that basically account for 60% of assets. So the role of state-owned banks in India is actually formally bigger than in China. And both countries actually do directed lending, which means the banking system does not only work on commercial principles, but it's encouraged and guided to support particular sector of the economy. Another one, very similar, is that as part of their development, non-bank financial institutions emerged, in some places called shadow banking, and then they end up in a crisis, and then it has adverse implications for the financial system and the economy. Both countries have had more recently similar experiences. And again, with a view forward, the role of capital markets will be critical to foster sustainable growth, to foster competition in the financial system. So again, if one were to be a betting person, both equity and bond markets going forward will play a critical role. Now, another area where the two are very similar is that they're actually at the cutting edge of technology, especially in fintech and digitalization. Of course, China has the two big giants, Alipay and WeChat Pay, which account for 90% of all the market, serving each other 1 billion customers in 2023. What again might not be so well known outside of this region is that India has been not only catching up, but in certain areas now is also at the cutting edge. And that is true both for China and India, that even compared to Western economies, they're actually ahead of the curve. The story in India goes back, and it's only a few years ago that India started with what they call the India Stack, by first having electronic IDs for everybody. Now basically every Indian has citizen has an ID, linking it to bank accounts, and more recently then to payment transactions. Another area where India and China are moving ahead very quickly is that on central bank digital currency. Both of them have very developed by now pilots, and we'll see who will be first in potentially launching a CBDC. And then there is an area where both countries have similar objectives. We heard a little bit about that before, and that is an engagement with the global south. In some of these areas, there will probably be competition among them. But when it comes to other issues, such as industrial policy, where China has its infamous Made in China 2025, India more recently started with a program called production-linked incentives. The objective is to develop domestic economies to ultimately become somewhat less dependent on reliance on foreign technology, and to foster, especially in the case of India, manufacturing. Now, there's another area where both countries have similar objectives and grievances. Both countries are a member of the group of G20. But they're also saying, you know what, the world has changed, but we are really not commensurate in terms of impacting the global governance structure, especially as it relates to financial institutions. We have grown, we are more important in the world, but that is not reflected in our participation in global financial institutions. And here on the right-hand side, just to give you a little bit of an example, I'm using the IMF. The gray bar, both for India and China, shows you their respective size as global output, global GDP, and then the red and green bar shows you the representation in both of these institutions. Obviously, there is a big gap, and that concern is not only a concern for China and India, for many fast-growing economies. So these two countries are clearly saying, for us to be represented, we need to have more influence, and we want to increase our share in governance. Now, that has then also led to the fact that both are part of alternative governance structures, including being a member of BRICS, and one of the institutions, the New Development Bank, where both are key partners. And then the last part is both countries are now providing financing to other parts of the world. Now, when you provide financing, sometimes things go bad. Countries run into difficulties in repaying sovereign debt defaults, for example. Now, both China and India are not part of the traditional organizations that deal with issues when countries cannot repay, such as the Paris Club. But as the case of Sri Lanka, for example, here in the region highlight, at the end of the day, since both of them contributed to the financing, ultimately they have to find a way to resolve the issues. They have actually collaborated and agreed jointly to find a way to get the restructuring done. So to summarize, the few points that I wanted to make is, first, both economies are critically shaping now the global economy, and that will continue. Secondly, on many of the global issues, without China and India at the table, there is no solution to be found. When it comes to bilateral relations, trade is strong. Most likely, in my judgment, foreign direct investments of China to India is likely going to pick up, which especially in particular sectors, and there will continue to be labor movement as well. In certain parts, India and China are at the cutting edge, and since I'm European, I can say that. Europe, be prepared. And the last one is that many of the grievances that China and India have, they are actually very similar, especially as it relates to global governance. Either institutions change over time, or if not, I think the prediction is that alternative governance structures will continue to rise. Thank you very much.